As of the first quarter of 2023, there were nearly 4,700 federally insured U.S. banks with combined total assets of $23.7 trillion and an almost equal number of credit unions, boasting more than 136 million members and $2.21 trillion in total assets. This staggering number highlights the significant role both banks and credit unions play in our financial system. But with such a vast presence, consumers often find themselves at a crossroads, trying to decide which path to take for their banking needs. Welcome to my comprehensive exploration of the financial world, where I dive into the age-old debate, credit union versus bank. In this video, I am unraveling the mysteries behind these two pivotal institutions, guiding you through their differences, advantages, and which might be the best choice for your financial needs. One of the most pressing questions I've encountered from our viewers is, are credit unions safer than banks? It's a valid concern, given the turbulent financial landscapes of the past. Stay tuned as I delve deeper into the nuances of credit unions and banks, helping you make an informed decision that aligns with your financial goals and preferences. Whether you're looking for a safe place to deposit your savings, seeking lower loan rates, or in need of a wide range of financial services, I've got you covered. Credit unions versus banks. Fees. Fees are a crucial consideration. Generally, credit unions are known for their lower fee structure compared to banks. This is evident in various charges, including non-sufficient funds, NFBs, credit card late fees, and mortgage closing costs. For instance, the average NSF at credit unions is $23.86, while banks charge an average of $31.24. Similarly, credit card late fees and mortgage closing costs are lower at credit unions, with averages of $24.56 and $1,151 respectively, compared to $34.18 and $1,361 at banks. This trend is supported by 2021 research from the Consumer Financial Protection Bureau, which highlighted that credit unions generally have lower overdraft and NSF fees. However, it's important to note that both banks and credit unions may impose a variety of fees, including monthly account maintenance fees, ATM fees, foreign transaction fees, and debit card replacement fees, among others. It's advisable to review the fee structure of any financial institution carefully to find an account that meets your needs, potentially offering low-fee or fee-free options. Branches and ATM access. While digital banking has reduced the need for in-person services, many customers still value the convenience of physical branches and ATMs. Banks typically receive higher customer satisfaction ratings for the availability and location of their ATMs and branches compared to credit unions. For example, Chase, the nation's largest bank, operates over 4,700 branches. In contrast, credit unions generally have fewer branches but have mitigated this disadvantage by forming the Co-op Shared Branch Network, offering access to more than 30,000 ATMs and 5,000 shared branches nationwide, where members can conduct various banking tasks in person. Interest rates. Interest rates are another significant factor. Credit unions often provide higher interest rates on deposit accounts and lower rates on loans compared to banks. In 2023, credit unions typically offered more competitive returns on certificates of deposit and money market accounts, while banks provided higher average returns on interest checking and savings accounts. When it comes to loans, credit unions were found to charge lower interest rates than banks across various products, including credit cards, fixed-rate mortgages, adjustable-rate mortgages, unsecured fixed-rate loans, home equity loans, used car loans, and new car loans. Although the rate differences for some products were minimal, credit unions generally offered substantially lower rates on credit cards and auto loans. Customer service insights. Customer service is a critical aspect of the banking experience, often highlighted as a key advantage of credit unions over banks. However, the American Customer Satisfaction Index (ACSI) survey for 2024 reveals a slightly different narrative. Banks have edged out credit unions in overall customer satisfaction, albeit by a slim margin. This suggests that both types of institutions are closely matched in delivering customer service excellence. The survey highlights that regional and community banks excel in customer service, outperforming both national banks and credit unions. This superior performance is evident in categories such as the courtesy and helpfulness of tellers or other staff, and the speed of financial transactions within branches. The personalized service often associated with smaller banks may contribute to their higher scores in these areas. Product offerings comparison. When it comes to the variety of financial services available, including checking, savings, debit/credit cards, and loans, credit unions scored slightly lower than banks in the ACSI survey. This discrepancy may be attributed to the broader range of services and products that large national banks can offer. For instance, international banking services, which are essential for frequent travelers or those living abroad, are more commonly found in banks than in credit unions. Credit cards are another area where national banks tend to dominate, particularly in the realm of rewards and perks. Credit unions, on the other hand, often focus on providing cards with lower interest rates, which can be a significant advantage for those looking to minimize costs. Digital banking and mobile app usage. In the digital age, the quality and reliability of online banking services are paramount. The ACSI survey for 2024 indicates that banks received slightly higher scores for website satisfaction and the quality and reliability of their mobile apps compared to credit unions. However, the difference in scores was minimal, suggesting that both banks and credit unions are investing in improving their digital platforms. Despite the slight edge banks have in digital banking, according to the survey, many credit unions offer competitive digital banking options. Prospective customers are encouraged to explore the mobile banking technology of credit unions and assess their websites for ease of use and the range of services offered. This proactive approach can help individuals find a credit union that matches their digital banking needs. Are credit unions safer than banks? The question of whether credit unions are safer than banks involves understanding how each type of institution is insured and regulated. Both banks and credit unions offer federally insured safety for deposits up to $250,000, but they are insured by different federal agencies. Banks are insured by the Federal Deposit Insurance Corporation (FDIC), while credit unions are insured by the National Credit Union Administration (NCUA). This means that in terms of federal insurance, both banks and credit unions provide the same level of safety for your deposits. Credit unions have a lower percentage of uninsured assets compared to banks. Contributes to the perception that credit unions may be safer in times of financial instability. For instance, during the banking crisis that began in March 2023, it was noted that failing banks had significantly more uninsured assets compared to credit unions, with Silicon Valley Bank having 90% uninsured risk. However, it's important to note that the safety of your deposits does not solely depend on whether an institution is a bank or a credit union. The critical factor is whether the institution is federally insured. Both FDIC and NCUA insurance protect up to $250,000 per depositor per insured institution for each account ownership category. This means that as long as your funds are within the insured limits and categories, they are protected regardless of whether they are held in a bank or a credit union. The choice between banks and credit unions ultimately depends on your specific financial needs, preferences for customer interaction, and the importance of digital banking capabilities.